The rate is dependent on the rate you're getting in their interest. For instance, if you're getting 1% on your savings account, you could borrow against that savings account and probably get a loan for about 3 or 4%. And at the end of the loan, you would still have the money in your savings account. Then there's unsecured loans, like credit cards. Unsecured loans are risky because if you don't pay them back, the bank's left with nothing. And because they're riskier, the interest rates are higher. That's why the savings account loans are cheaper, because if you don't pay it back, they just take your money. But again, secured loans, collateral, lower interest rate. Unsecured loans, no collateral, higher risk, higher interest rate. Let's looking at payment plans or terms. We have installment plans in which you pay the principal and the interest to pay back the loan until the loan is paid off. Examples of these: mortgages, car loans, personal loans. Revolving loans, you pay back the principal and the interest, but when you pay it down, you can borrow back up against that amount. For instance, a credit card, if you have a $5,000 limit, you spend $3,000, you pay down to $1,000, you can pay back up to $3,000 or $5,000. Let's looking at the 4 C's of credit. These are the things lenders look at when they're determining whether or not to give you a loan. The 4 C's of credit. Okay, go ahead. Wait, would somebody give him a mic? I was gonna wait till later, but I have no problem with that.
My question was regarding consolidation loans.
Consolidation loans?
Yeah.
Okay.
A lot of times you get into debt, and that seems to be a lot of times the option that a lot of the banks offer us.
Yes.
Where you can bulk up all the credit cards and all the other little loans into one monthly payment.
Yes.
Instead of making 5.
Mm-hmm.
I've been advised that's okay, and I've been advised that's not.
Mm-hmm.
Could you touch up on the pros and cons of taking a consolidation loan?
Sure I can. Sure I can. All right, oh good. The things about consolidation loans, and I'll tell you, this has been in my experience. A lot of times people get into, they have a lot of debt, and mostly it's unsecured debt, it's credit cards. And the thing with a consolidation loan, this is the pro of a consolidation loan. You put the whole loan together, you have one monthly payment, and sometimes that payment is less than what your payment would have been had you been making separate payments. So that's one of the pros of the loan. One of the things about those loans is usually with all that debt, sometimes you don't even qualify for a consolidation loan because there's a debt to income ratio that you have to meet. And usually, like I said, when you have all that debt, you don't even qualify for the loan. Another major con for the loan is that usually, let's say you have 5 credit cards. You put them all together into this consolidation loan. It might be a home equity loan. You put them all together. Well, unless you cut up those credit cards, hide them, freeze them, if you didn't change your tendencies, you know what you're going to do? You're going to have a $50,000 consolidation loan, and then you're going to have a new $50,000 in credit card debt. That's why change is so important. It's so important. Those are the pros and cons. Those are the pros and cons. Now I'm going to defer to Michelle. Michelle Heine is here. She's an attorney who deals with credit restoration. Is there anything else? Oh, not yet.
Hi. On the same vein is basically also you're going to be putting your house a lot of times up as collateral, and usually they're more like a 30-year loan. So you're going to be paying on short-term debt for a lot longer, which basically you covered. And is that the kind of loan? Because the other consolidation that I've heard of is the companies that you pay them all the payments to them, and then they disperse and they make the payments. That's not what you're asking, though, correct? Because those, I would be careful. I would definitely be careful. As far as from a credit standpoint, which I'm going to talk a little bit about credit, that actually reports as if it were a Chapter 13 bankruptcy on your credit report if you go to a consolidation company. So I would just look at a lot of other options. I initially thought it was more of a refinance consolidation, but I'm glad I brought that up because yes, I'd be leery, and that may be why you're getting feedback both ways. Right.
that would be the other option.
Right,
Because
and
you don't have enough home equity to cover for the loan. So then you have to go and, like, let's say to Wells Fargo or something, then they give you the consolidation loan. I did not know that qualifies for Chapter 13. That's
if you go to a consolidation company, more like, I don't know the name of debt relief or some company like that versus the consolidation loan.
Thank you, Michelle. And you know, if you have questions, no, let's just move on. Good. The 4 C's of credit. These are the things, like I said, that lenders look at, and these are important when considering a loan. Capacity, how much money do you make each month, and what are your monthly expenses? So they're looking at these things to see really if you can pay the loan back. Capital, how much money do you have in savings? Some loans require a down payment. So they're looking at what are you willing to put into this loan? Character, have you had credit in the past? How have you handled it in the past? And how many credit accounts do you have? They look at that. You might have 10 credit cards, and that's all the credit you have. They want to know, do you have a house? Do you have car loans? Do you have credit loans? Do you have loans from finance companies? Because all these things determine that. And I'll tell you, when I was doing loans, if I saw a loan from a finance company, your score with me might go down. The reason being is because a lot of people go to finance companies when they can't get a loan from a bank. So that tells me a little bit about your credit. But sometimes you can get a loan from a finance company through Best Buy, because usually department store credit cards are through finance companies. Those are a little different, but those two, those are some things we looked at. And also it's the mix of credit. Like I said, is it installment credit? Is it car loans? Is it personal loan? Or is it all credit cards? Having a mortgage, very, very important. Because if someone gets a mortgage and they pay it well, it says a lot about that person and their credit. So we look at the mix of loans also. And collateral. Do you have any collateral? Sometimes people can't qualify because unsecured loans are very, very risky. And sometimes they'll say, well, what can you put up? Can you put up a car that's paid off? Do you have a house for a home equity loan? So collateral is very, very important. 4 C's to avoid. Now these things have all been reported here, and it's something that we should look at very seriously. 4 C's to avoid. Cars. When we look at cars, you should really only buy certain cars if you can park it on land that you own. And I say that because a lot of people in our community like big, big cars. They like Hummers, they like Escalades, Navigators, and then they drive it up to a place where they're renting. And the car is as much as, or more than, the cost of rent. So we should be careful about the cars that we buy. It's also reported that clothes, black men buy 70% of all shoes that cost over $300. 60% of all hats sold in America that cost more than $50 are bought by black men. Now, I wasn't sure about that till Sunday. Somebody told me they liked the hat I was wearing, which cost less than $50. But they liked the hat, and then they told me they had about 4 hats, and one of those hats cost $175. They're not here. But really, I was $175. I mean, I like a nice hat. To me, that's a lot of money. To me, that's a lot of money. Cosmetics. It's been reported that 15% of all women, which are women of color, black women and Hispanic, buy 45% of all cosmetics. I don't know. Okay. And then the last C is credit. When it comes down to it, we buy all these things with credit cards. 4 C's to avoid. It's not saying you shouldn't buy cars, but think about which car you're buying. It's not saying you shouldn't buy clothes, but how much do you have to spend? Cosmetics, well, and then credit cards, buying it all on credit cards. That's not the use of credit cards. Again, if you don't know the purpose of money, inevitably you'll abuse it. If you don't know the purpose of a credit card, you're going to abuse it. It's not just to buy as much as you can.